decision-making and relevant information. We're going to look at some applications of relevant costing, and your homework problems and quizzes will also have some applications. So hopefully this lecture will be pretty close to what's in the quizzes and what's in the homework. I think it is. But of course, as always, you should look through the notes really closely, and then also have some extra multiple choice in the notes. Maybe work those out and look through the book as well. So decision making really important for organizations, and management accounting is an integral part of decision making. Many firms have a 5-step decision making process: identify the problem, obtain information, make predictions, choose alternatives, and implement the decision. Relevant costing is similar to this, except for we really focus. We still have a problem that we have to identify, but the information is going to be related to relevant costs. So we gain all pertinent information, qualitative and quantitative, and then we basically focus on relevant costs and make the decision based on relevant costs, which is 2, 3, and 4. So in order to do that, of course, you need to define what relevant costs and relevant revenues are. So I guess there's 2 thresholds that you have to meet. The relevant cost must occur in the future, and it must differ among alternatives. So the relevant cost cannot be a past cost, and we call those sunk costs. So a relevant cost is never a previous cost. So, if I'm deciding to replace my machine, I bought a machine 5 years ago, and it cost me $5,000. The new machine is going to cost $7,000. The $5,000 that I pay for the new machine, other than if there's maybe any salvage value, that would be relevant. But the $5,000 that I paid for that machine would not be relevant. That's a sunk cost. So anything that we bought in the past, anything we paid for in the past, and it could be just a week ago or a day ago, is considered a sunk cost, and it should not be used for decision making. The second threshold is that it must be a differential cost. It must differ among alternatives. So variable costs are, future variable costs are common relevant costs, but if they're both the same, if variable cost for machine A is $500,000 and variable cost for machine B is $500,000, then I'm not gonna use that information in making my decision because there's not a differential. So they must be differential and they must not be sunk. All right, so I've got just a couple of multiple choice questions. Cost is not relevant for decision making if which of those is true? It's not relevant if it's not differential. So A is true. If it does not differ for each option available to the decision maker, then it's not going to be a relevant cost. The others could be a relevant cost, but again, they have to meet those 2 thresholds. Can't be sunk, have to be differential. And then the second multiple choice, which of the following concepts is correct for determining relevant costs for short-term decision making? And its first one must be differential in order for it to be a relevant cost. Differential and future. All right. I mentioned earlier that we look at both quantitative and qualitative. So quantitative is anything numerical. So the cost of a new machine, cost to run the machine, if we're looking at replacing a machine, salvage value of the old machine, all those would be either differential or incremental. Qualitative, there's some things that we cannot, put a number to, quantify, but they might be important. For instance, let's say I'm deciding to make a product myself or buy it from an outside supplier. So if quality is important, I'm probably going to consider making it myself because I can control quality in my own plant more so than I can do in someone else's plant. So that would be a good example of where qualitative could be important. So you might look at the quality of the product or the quality of the machine or durability. All those things are qualitative. Reputation, maybe, of the person you're buying the machine from. And then opportunity cost is contribution to income that's foregone by not using our limited resource. So let's say I'm going to make or let's go back to make or buy a component part. If I buy the part, I can rent my plant out and I can receive $10,000 a month. So that $10,000 would be an opportunity cost, right? An opportunity cost if I buy it from an outside supplier, I'm gonna receive $10,000 more a month. If I don't do that, if I make it myself, I'm not going to receive that rent. So that's an opportunity cost. And those are taken into consideration in relevant costing. So some types of decisions made by relevant cost analysis. Add or and we'll be looking at these, some examples of each of these. Add or discontinue a product line. Sell or process further. Sell a product at a split up point or process it further. Special order. So all three of those I think are either in your quiz or in your homework or both. Make or buy as well, I believe, is in your homework. And then product mix decisions under capacity constraints would be the fifth one that we're going to look at in the notes. Two potential problems that could occur. We want to avoid assumptions that all variable costs are relevant, all fixed costs are irrelevant. Some fixed costs can be relevant if they're differential. If I'm going to decide to make or buy a product and I have a supervisor, I can't use him. If I'm going to buy this product, I'm going to have to let him go. The cost of that supervisor's salary, it's a fixed cost, but it's going to be relevant because it's differential and it's future. It meets both those requirements. Same thing with variable costs. A variable cost may not be differential. If it's not differential, it's not going to be a relevant cost. We want to be careful of unit costs because those are sometimes misleading. All right, so here's the first example. Add or discontinue a product line. So again, all of these we're going to look at relevant costs. And there's maybe I could call them a little bit of tricks to each of these. For the add or discontinue a product line, I can look at my contribution margin versus any costs that can be avoided, the relevant costs. The future costs can be avoided. So this company, I'm looking at these two divisions, and Cosmo's division has a $20,000 loss. So you might think at first glance, hey, they dropped Cosmo's and they're going to increase income by $20,000. But that's not true because Cosmo has a positive contribution margin, and that contribution margin is covering some of our fixed costs. So if we were to drop Cosmo's, we're not going to increase income by $20,000. The only time you would look at this and say, hey, I got to drop this division if you have a negative contribution margin. If variable costs are greater than sales, then always, because every product you make, you're losing more. So if contribution margin is negative, then you're going to drop the division. In this case, contribution margin, though, is positive. So what I want to look at is contribution margin versus any costs that I can avoid. All right, so the 160, and by the way, say, well, what about the variable costs? Well, because I'm not using sales, I'm using contribution margin, so variable costs have already been taken into consideration. All right, so I'm going to look at my contribution margin. I'll compare it with any costs that can be avoided. So those would be the direct fixed costs, and that might be, say, salaries of supervisors. Related to the division, we're going to save money on that. All right, and that's all we have because we already took into account the variable costs. So in this case, the contribution margin is greater than those fixed costs that can be avoided. So I'm going to go, in this case, not to drop that division. Because if I were to drop the division, what would happen is I would lose $35,000 more in income. Because this division's contribution margin is covering some of these allocated fixed costs. Because these allocated fixed costs aren't going to go away. If I drop this division, this $55,000 will be allocated to Stargate. All right, sell or process further. Again, looking at relevant costs and relevant revenues. So I can sell this at the split up point, and that's $340,000. I got three products, $340, $150, and $110. But I have an opportunity to process further for each of these. So what I want to look at, this is very easy, very common sense. I just want to look at incremental revenues versus incremental costs. That's my relevant revenues and relevant costs. All right, so my sales value at split up is $340. If I process it further, I'm going to get another $8,000. But it cost me $38,000 just to get that $8,000. So that doesn't make any sense. So I would not process X further because incremental costs of $38,000 are higher than incremental revenues of only $8,000. For Y and Z, we see that our sales value at split up is $150. My sales value processed further is $185. So I got a $35,000 incremental revenue. $30,000 though in incremental costs. So hey, I'm going to process further. I'll make an extra $5,000. And then the same thing for Z. In this case, it's $15,000. So those are interesting, and I think you do have a couple of those problems in your homework. Special order decision. This is whether or not to accept a special order, and it depends again whether incremental revenues are greater than incremental costs. This is a short-term thing, so you're not always going to want to accept these special. You don't want to accept this price for all your units because it's going to be normally it's going to be a lower price. So sometimes it's a price that might occur between two presidents of an organization. Hey, I got some excess capacity. Why don't I make you 5,000 units? I'll give you a better price. So let's take a look at this. I've got, I'm just kind of got a little screwy down here, but if you take a look at this, I get incremental revenues of 16,000. Why? Because the foreign distributor is offering to buy 1,000 units at a price of $16 per unit. So total revenues are 16,000. All right, so that's a special order. We're not normally going to make this order. It's a one-time deal. So it says, hey, I'll give you 16,000. So we got to figure out whether or not we should take this order. So there are some incremental costs that we're going to have. Direct material, direct labor, and variable overhead are always going to be incremental, right? We're always going to have to spend those variable costs. Those are future variable costs that meet both requirements. They're differential and they're future. So if I didn't make this 1,000 units, I wouldn't have the $6,000 in materials, $3,000 in labor, and $2,000 in variable overhead. All right, so $6 per unit for materials times the 1,000 units. All right, and then $3 of direct labor times the 1,000 units that this guy's buying from me. And then the variable overhead is 40% of this $5, so it's $2 again times 1,000 units, so $2,000. Also, we've got $1,000, $1 times 1,000 of shipping costs. So my total relevant costs are, and in this case they're all variable, are 12,000, and the incremental revenue is, or incremental income is 4,000. Now that's not to say I could have a fixed cost in a situation that could be relevant. It could be I have to hire another supervisor. So that would be a fixed cost. But in this case, we don't. All the costs are variable. But we're going to go ahead and do this because I've got an incremental income of $4,000. Now this price is lower than the normal price that I use, and I probably wouldn't want to use that price for all my units. But for a short-term situation, a one-time deal, I'm more than happy to do it to get this extra $4,000. All right, make or buy decision. So here we're going to look at the cost of purchasing from an outside supplier versus any incremental costs I have from making it myself. So the incremental costs of making it myself are always material, labor, variable overhead. Fixed overhead is not an incremental cost. Fixed overhead, if I make this product or not make it, this fixed overhead is allocated fixed overhead is going to occur either way. All right, so the only variable costs, the only costs that are incremental here are the material, labor, and overhead. The $80,000 is going to happen. It's my plant cost, my depreciation cost. It's going to happen whether or not I make it or buy it. All right. And then another cost that we have is this opportunity cost. Because if we buy it from the outside supplier, we can go ahead and rent out our plant for $10,000. So that would be taken into consideration, this opportunity cost of $10,000. All right, so cost of purchasing from the outside supplier, his cost is $17. His price to us is $17, and 20,000 units are going to be manufactured. So we're going to buy 20,000 units from him at a cost of $17. So our cash outlay, $340,000. That's relevant, right? It's a future cost. It's not sunk, and it's differential. If we don't do it, we're not going to pay $340. So it's either 0 or $340. So it's differential. So $340 is differential, and it's future. All right, then back in the plan, if I'm going to make this thing myself, I got to pay $100,000 for materials, $160 for labor, $60 for variable overhead, and then I also have to take into consideration the $10,000 of opportunity cost. So those costs are $330. So it looks like if we're just going to base this on cost, that by $10,000, it favors the make decision, right? $330,000 to make the product ourselves, $340,000 to buy it from the outside supplier. Okay, then the last one is product mix decisions under capacity constraints. For this, we need to find the contribution margin per constraint. So here's my contribution margins for the two products. I divide by the constraint, and my constraint is raw materials. So I divide by 3 units of raw material for simple product. I use 3 of these. So it's $4.25 per raw material, and the other one is $4.10 at 2050 divided by 5. So I'm going to go with simple product to $4.25. I'm going to make as many of those as possible until I run out. If I have any materials left over, then I'll go ahead and use the on the advanced product. But if I've got a shortage of raw materials, I'm going to make the simple product first because the contribution margin per constraint is higher with the simple product. All right, that's all I have. A little shorter lecture this time. So you have these types of problems in your homework and quizzes. If you have any questions on either homework or quiz, don't hesitate to contact me. The quiz, you're just going to have one shot this time on the quiz. The homework, though, you'll have as many times as you need. All right, I will see you next week in the lecture, and have a good week, and I'll talk to you soon. Oh, and as far as final exam goes, I'll have some information on that in the next week or 10 days. Thank you.